Hello and welcome to Big Deal. Now, as the year 2022 really comes to an end, today we are going to focus on the year that was for the deal street, the key highlights there, and then also crystal gaze into what's coming and picking up on the key trends for the next year. And to delve deep into it and give their perspective, I have two top deal makers of the country. Let me welcome on the show Manisha Girotra, the CEO of Moelis India, and Zia Mody, the founding partner of AZB and Partners. Ladies, always a pleasure to welcome you on CNBC-TV18. Welcome. Zia Mody, since we spoke last time, a lot has changed on the economic front, the perception front, but our market has been quite resilient with the equity markets really hitting record highs. On the other hand, also the deal street has been buoyant. How do you summarize this particular year?
God is kind. Certainly the situation with Russia and Ukraine and the whole disaffection, if you like, with China has had only one beneficiary in that sense, which is India. So I think that the deal outlook, if you like, for the next year, it won't be bad, but it will be slow and steady. I think what will make it a bit slow is the valuation reset. It's happening, but it's happening, as you can imagine, slower than we as intermediaries would like to do deals, because the promoter has been used to higher multiples. He is to understand the world has changed. The global sentiment is not as enthusiastic for themselves as we are about ourselves. So I think, not that much to worry about. In a way, it's ours to lose with the China plus one strategy, with people really looking to come to India. You look at the iPhones, etc. So I'm not pessimistic. I'm not, saying everything's going to be a gangbuster. But I think if India does the right things and holds its own, it's ours to lose.
All right. So cautious approach there from Zia Mody, and this is one of the few times that I've seen you more cautious, Zia. So Manisha, what do you think? Of course, on the deal street for this particular year also, in terms of value of M&A, if we really dig deep into the numbers, if it was not for HDFC and HDFC, bank merger, which had been imminent for quite some time and was quite a bulky transaction in terms of numbers, apart from that, the value for the deals has been similar to the last year, which was a more difficult year. How do you summarize, and how much business are you really expecting for the next year?
Thanks, Nisha. I think just to add what Zia said, while God is kind and I think India stood out in terms of growth compared to the other countries, I think also we are benefiting enormously from the structural reforms that we undertook in the last 10 years. And the reforms that we're promising to undertake in the next 10 years. So I wouldn't be, while I'm cautiously optimistic, I strongly believe that India will attract a lot of capital just because of what we've done in the past. And I'm sure as we'll talk, I believe that capital will now not just come into the few sectors that it used to come in to play the Indian demographics, but in a wider set of sectors as people are getting more comfortable on just India as an economy and the Indian government and its seriousness to reforms. Coming back to what you said, I think this year-to-date, M&A has been about $170 billion in India, which is about 20% of the Asia-Pac M&A. I agree that one of the largest deals there has been HDFC Bank, which we've been an advisor to. But I think that's good. I think what this is demonstrating, whether it's the HDFC deal or Adani buying Holcim, it's demonstrating that Indian corporate is back and active. Through the NCLT process, we saw basically balance sheets of banks and corporates getting cleaned up, and all that Zia and I would go to if we had any sell-side opportunities was to basically private equity or foreign strategics. And a country which aspires to be $5 trillion, $7.5 trillion in size must have a dynamic Indian corporate sector. And I see what's happening as a trend very heartening. And I hope more of it happens as global multinationals will withdraw from countries as growth slows down. I want Indian corporates and Indian corporate sector to and Indian private equity to come in and buy some of these assets because they can actually have a much longer
right Slightly scratchy line there from Manisha, but the biggest takeaway that I got from Manisha also is there private equity has to participate more, and in fact, Zia, and you'll agree with this, that private equity has kept the deal street ringing. And you have a keen eye on the big conglomerates, the corporates in the country, Zia. Now, apart from the top 4 or 5 corporates that we see and the conglomerates with deep pockets and the intensity to buy out and also get bigger, beyond that, how is the rest of the scenario looking in terms of sentiment, animal spirits to do acquisitions and also to grow their businesses when it comes to greenfield, brownfield expansion?
So I think domestic corporate sentiments absent strategic buys are still mildly positive. I think people are still wanting to create a situation where they have a war chest, if necessary. A lot of the smaller ones and not the big boys, the Indian big boys we're talking about, don't want anything called IBC coming close to them. So they're deleveraging as much as possible. I think private equity has raised so much dry powder globally last year and this year that they need to deploy. So I truly believe that if there are opportunities here, you will see a lot of competitive bidding. I'm seeing the deals that are flashing on your screen. The Shell one, for example, was Shell's first acquisition into renewables in South Asia. We acted for Shell, but that shows their commitment. BlackRock came in into renewables, into Tata Power, but these are still FDIs coming in. The domestic merger market, I think Manisha will have more of a sense. I see it not happening, but I think HDFC was an exception, if you like. Now, when Adani has bought Holcim, if Aditya Birla can find some local acquisitions, they might well go for them. So you will see domestic deals, but I still think the FDI coming in and the deals from outside will probably outweigh, simply because the sentiment is India is the place to invest in. And frankly, all we have to do is to make it a little easier for everybody.
Right. So Manisha is back with us. Manisha, you were raising a point of private equity participation, and Zia also said that a larger part of heavy lifting on the deal street would be done by the investors, especially foreign money. But right now is the time, Manisha, when most of the global funds really allocate their next year's funding for and also geographically as well as segment-wise take a decision. How are you seeing the investors really looking at India? And do you think that the money will be a little more skewed because of the interest rate hike that we are seeing globally?
Thanks, Nisha. I think foreign capital will be dominated by private equity. I don't see strategics coming in such large deals or transactions just because of what's happening globally in terms of the slowdown, etc. Private equity in 2021, as you know, private equity plus VC put in about $75–80 billion of capital to work in India. In the current year, they put in $40 billion. Year, as Zia started off by saying, which has seen unbelievable disruption in terms of Ukraine supply chain, Fed rates increase, etc. So I think despite that, you saw $40 billion of capital coming in, which is substantial. They will continue to put capital to work. And as I said before, they will not just put capital to work in consumer and pharma sector, but because of the reforms that we are seeing, the structural reforms that we are seeing, I'm seeing more capital come into infrastructure, renewables, etc. Zia mentioned the Tata BlackRock deal. You saw a fund like CPPIB, which traditionally doesn't take control stake, buy a majority stake in Renew. So I think it'll be a more diversified spread. But I think you raised a very valid point, which is that the leverage market is tight. And that's probably why you saw lesser capital being put to work in India and from the private equity in this year. And if that continues in the next year, then we probably won't see deals of the scale that we saw in terms of Hitsaware, Carlyle, etc., which was like $3 to $5 billion. Probably see fewer of them. But the positive on the other side is the fact that you're seeing funds come into infrastructure, roads, ports, transmission, which was very much needed. We just couldn't have domestic capital funded the enormous infrastructure need for India. And I think with the digitization of the logistics sector, you're now seeing a lot of foreign capital coming there. So a bit of a mixed bag. We'll see how 23 plays out. Leverage is, of course, the biggest play here, which we need to see more of coming if you want to see private equity play larger deals.
Right. So, Manisha, you actually mentioned a bunch of the sectors which are really keenly watched out by the private equity, and there is enough interest. Infrastructure is something that India needs to grow in, and there the foreign investors are really very keen. On the other hand, logistics, because of the boost that was given by GST, and the sectors of the future like renewable energy. These have really been on top of the agenda for the investors, along with our financial services. Zia, you have any insights on the sectors we should watch out for, which are attracting most amount of interest, so far undiscovered by the investor community for the next year?
So I agree with Manisha. I think the spread is going to be much larger in terms of sectors. Traditional favorites have been, pharma, healthcare, etc., simply because of the consumer dynamics. But I think that India is courting the large patient infrastructure capital. And that you will see a lot with the sovereign funds, both from the Middle East and from Canada and hopefully other jurisdictions, Korea. I think that government wants to show investment in infrastructure of all kinds. You're seeing green hydro, you're seeing renewables, you're seeing roads, assets, which are, going gangbusters in terms of M&A, airports. The government realizes that to grow into the economy that it has to, it needs the infrastructure. And the most patient capital is sovereign wealth funds. So I think they'll go for that first. And then KKR, Warburg, and all the other big boys, Carlyle, etc., Brookfield, are all raising funds which are for infrastructure. Yes. And so they will have to allocate it to this sector. So I think the one big change I see is that there'll be more infrastructure investment than before by PE. And probably the startups and the fintechs, that may slow down a bit until life settles for them and it starts again.
Right. And Zia, you made a very important point. The annuity-based kind of funding or a long-haul funding is what is required for infrastructure. And in the absence of cheap capital that were to come, but the debt market is looking now largely expensive and also doesn't have the horizon of 20-25 years of debt for infrastructure. For that, sovereign wealth funds as well as some of the private equity can now play a very big role, also because of the comfort of REITs and InvITs as a category being created so well, where they can deleverage, roll it out, and then put money back into newer funds. So that's a very interesting and important point and a big takeaway for the next year. But we'll slip into a break. We have lots more to discuss, especially on the valuation dynamics. Big mismatch there. Is that going to be creating a big hurdle on the deal street coming year? Stay tuned to Big Deal.